Why do I hate TSLY or TSLY stock so much? I'm going to talk about that as well as Coney and all the yield max funds and go into exactly what I don't like about them. Those of you who've owned it for a little while may understand now what I was talking about because I did a video on this about 6 months ago. And now we're seeing some of the things that I discussed come to fruition. So stick around, this should be a really good video.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor, on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Hello, my YouTube friends, and happy Saturday. I hope you're all doing well. I hope you all had a decent week. I'm going to talk about TSLY stock, the yield max funds, and why I really hate them. If we're lucky, I'm actually going to try to get 2 videos out today. I also want to go into more in depth about why I don't see a real estate collapse coming and the differences between now and before. I talked a little about it yesterday, but I wrote it down and I want to go into an in-depth review of that as well. So we might see that video a little later today as well. But this one's going to be about the yield max funds and what I really don't like about them. Now, I don't know how many of you own these stocks. I'm going to use TSLY as the main example just because, I don't know, there's a whole bunch of them. I'm sure they do it with Palantir. I know they do it with Amazon and the others. And for starters, one of the things I don't like is you're primarily getting all the downside risk by owning these funds, and you're limiting your upside potential if the stock that's the underlying equity does really well. So let's start out by talking about what actually they do and how these funds work. So you take a company like Tesla that closed the week around $250 a share. What they do is instead of buying the stock, they buy an at the money call and they sell an at the money put. Now, for those of you who aren't familiar with options, I'll walk you through it. Hopefully, you understand it and it'll all make sense because this makes you what's called synthetically long the stock. You didn't literally buy the stock, but you're going to be long no matter which way the stock goes. That's why they call it synthetically long. So you've bought a $250 call. That means you can buy the stock at $250 if it goes higher. You've sold the put. Now, this is what confuses people sometimes. You sell a $250 put, and if the stock goes lower, you're forced to buy 100 shares at $250. So either way, no matter which direction the stock goes, you are going to end up being long 100 shares of stock when that option expires. And in the yield max funds, they do this weekly. Now, what's the advantage of that? Why would they do that? The advantage is one of a couple things. Either it allows them to be, what's the word I'm looking for? Either they can buy more shares and be more leveraged because you don't have to put up as much money, or they could be the same amount of shares and put the additional money in a treasury bill to get some sort of return on that investment as well for the same reasons. And here's why that's the case. So if you work an agreement with whoever you're clearing through, so you might be set up with JP Morgan, Morgan Stanley, Chase, any of the banks, and there's some that people aren't familiar with the names of that do the same thing. Well, if you buy a $250 call, all you have to do is pay the money for the call. And I took a look, and let me pull it up. Forgive me that I look away for a second. The $250 call, the middle between the bid and an offer. So I didn't just like whack on both sides where it gives worst case scenario, was approximately $8.05. So if you're buying the call, for every 100 shares, you're only paying $805. Now, again, if the stock goes higher, you're going to want to buy the shares and you'd actually need the money at that point, but you can continue to roll the options so you never really have to put up the full money to buy the stock. The $250 put, the middle between the bid and the offer, was $8.95. So if you bought the call and you sold the put, you're actually going to collect 90 cents to have this position on. So technically, if that was all you did, your risk is to the downside, like you'd get your 90 cents And if the stock goes higher, you're long the stock. And if the stock goes lower, you're going to start losing money as it continues to go down. Part of the reason the put is more expensive is it didn't close exactly at $250. It was a little bit below, so you're getting a little bit more for the put because of that. Then what the yield max funds does is they then sell an out of the money call against the synthetic long. Generally, they're looking about 5 to 10% higher than where the stock is currently trading. Now, the reason they do that is that's what they're using to be able to pay their dividend. And it's not really a dividend, it's a payment of equity, it's a payment of return, it's things like that. And if they're looking somewhere between 5 and 10% higher from where the stock is trading, well, they're looking between the $262.50 call all the way up to the $275 call. And they're selling those options against the ones that they put on. So if the stock goes higher, for example, you've bought the $250 call, let's say, the $262.50 call between the bid and the ask was about $3.60. So if they sell one of those against one position that they've put on of the call put spread, so to speak, they would make their $3.60 and they make the $12.50 from the stock going higher. Now, the $275 call was approximately $1.30. Same thing, if the stock went higher, you collect that $1.30, as well as you've now made $25 on the stock. Now, I ran the scenario for 4 different calls, and essentially I did it as if you had 400 shares of the stock, or you had 4 calls and 4 puts on. You could sell, what I used was the 262.50, the 265 call, the 270, and the 275. If the stock just did phenomenally well and went up to 275, you'd make about $8,220 on that position. Now, that wouldn't be an individual person's profit, that would be how the fund would work. But here's the problem with that. If you were long 400 shares of the stock, you would have made 10 grand. On the flip side, if the stock goes lower, since you're short the puts, you're forced to buy in those options as well, or buy in the stock at $250. You're going to lose the full amount of the stock falling, less what you're going to receive in what they're calling the dividend by selling the options against it. The only way you really end up better off owning these stocks versus just buying Tesla if you like Tesla is if the stock actually falls in value, because you're getting a little bit of the premium back based on the calls that they're selling against that trade. Now, I don't really see any huge advantage of this. And if you look at what the stock has done since Tesla's had a pullback, in the last month alone, it fell from 11 to $8. They paid a 46-cent dividend, but overall, you've lost $2.50. And if you look over the past 3 months, it's fallen from $18 to 8. So while Tesla has fallen in half, TSLY has fallen in more than half, but they've given you a dividend in the meantime. And what I really hate about these funds is the way that I always see them sold is they're good for people getting into retirement who could really use the dividend. Well, if you look at the dividend yield, it's based on today's stock price. So you might have bought it for $18, hoping to get 100% return or whatever the numbers are over a year. Yet meanwhile, the stock has fallen more than in half in 3 months. And despite the high yield that they're showing, that's based on the $8 share price that it's trading today, not the $18 that you might have invested in it 3 months ago. The other thing is, you better hope that the fund managers are really good traders, because one of the things I've heard them talk about is they can even sell lower calls to increase that premium if the stock starts to fall in price. Now, that's just called trading. Anytime they decide to get out of the options that they've put on and re-hedge them by putting on others, that's just their decision that either they think the stock is going to fall further or potentially go up. And I don't know, based on what I've seen in terms of the stock price, I'm guessing they aren't the greatest traders in the world. And again, what really bugs me is here they are selling this to people who are going into retirement to help them to be able to pay their bills. And let's just say you bought 100 shares at $18 3 months ago. You spent $1,800. Maybe you've collected, I don't know, $150 in dividends, which sounds great, except your value of your stock is now $8. And there's no guarantee that it won't continue to fall. And quite honestly, if Tesla continues to have more of a pullback, TSLY is going to have a bigger pullback as well. And you could potentially lose your investment. The other part I don't like is what they're constantly talking about is people going into retirement can use this because they might need the income, but the best way to use the strategy is to reinvest those dividends. Well, what a terrible thing to say. If I need that money for my retirement, how can I afford to reinvest those dividends? And if I've put another $150 over the last 3 months into a stock that's fallen from $18 to 8, man, I'm only going to have about $1,000 worth of equity on an $1,800 investment, which sounds like a pretty bad investment over 3 months. So, how dare you sell these funds to retirees who might need this income to pay bills with this impression that this is great return that you'll be able to rely on, when that is so far from the truth from the amount of risk that these funds are taking on? And the people getting into them, I've said it 100 times, don't really understand the risk that they're getting into. That's why I hate them so much. And then you have all the videos on YouTube talking about how phenomenal these funds are. Now, if you really want to do call covered options or trade covered calls on a stock, I suggest people learn about it themselves, figure out how it works, and don't just blindly invest in these funds that pay these really high dividends, because that's stating essentially how much risk they're taking on. Now, please keep in mind, this is not financial advice. Do not listen to me. You need to do your own research on the investments you make for your portfolios, and maybe even seek out the advice of a financial planner to help you with these decisions. My concern with this yield max funds is the sales pitch. I don't necessarily mind the strategy, I mind the sales pitch. These are not safe investments. They're using derivatives, taking on a lot of risk, and then selling people that get attracted to high dividend yields. And that's always a mistake. And then you have the YouTubers who go on there talking about how great these funds are. And I've even commented on some of their pages, and they come back and tell me how stupid I am and I just don't understand. Well, I hate to tell you, I told you so. And I really didn't hope that would happen with anybody. I don't want to see anyone lose money. But please pay really a careful attention to these yield max funds and what they're doing, because I don't think most of you really get the risk they take on. You don't want to be taking that type of risk if you're going into retirement. I understand that getting a 3% dividend does not look super attractive unless you have a lot of money where that 3% is enough to be able to pay your bills. But the reality is, when you look at the companies that are paying out a smaller dividend and actually make enough money to be able to pay those dividends, it's a much safer investment and probably a better quality company. And to be perfectly honest, these yield max funds, they aren't a company, they're just an ETF trading a stock hoping to generate income. And then the other issue is your best upside is to do worse than owning the stock. And if you want to own Tesla, maybe just buy Tesla. Again, not financial advice. I don't know that I like Tesla here, other than there's a lot of negative news against them. And to me, when there's negative news, sometimes that's a good opportunity to pick something up. The other thing is, take a minute to open up a chart of how this stock has done over the past 2 years. Because from the day it got into inception In 2023, at least from it looks like on the chart that I pulled up, it's fallen from approximately $42 a share to $8 a share. So over the past 2 years, for the $4,200 that somebody might have put in to buy 100 shares, they now have $800 worth of that stock. They've collected dividends along the way, and I suppose if they've collected more than what, 4,200 less 800, so if you've collected more than $3,400 over that time, at least you're break or even at $3,400. And if you've gotten more than that, you're up a little bit. But I'm guessing it's a lot of stress to have watched the principal drop that significantly while you've collected those dividends. So be careful, learn what these funds do. If you want to covered call strategy, maybe a JEPI or a JEPQ, which doesn't pay the dividend yield that these companies do, is probably a little bit better. But to be fair, it's the same type of strategy. They just do it against the indices and tend to have a little less volatility. I hope in those funds that they don't just deteriorate. But to be fair, if there's a big market correction, you're probably not going to do so great in those ETFs either. So be really careful with these covered call strategy funds. Do your research, take a look into the things that companies are buying, and know what you're investing in before you take more risk than you really intended. A lot of these funds, like just because they're managed by professional investors, doesn't mean that they're as safe as you might think they are. And if you have some security blanket thinking that they're running this great product, be careful. Learn a little bit about what it is, seek out the advice of somebody who is a professional, helps invest money, and can really explain it to you, hopefully better than I did, because I even heard myself sometimes where it sounded confusing. So you don't get into something that ends up really costing you badly, especially if you're doing this going into retirement, feeling like I need a little bit more income, so I'm reaching for those higher dividend paying things. There are options out there that pay higher dividends that I would feel more comfortable with, even with like an Altria. I understand they're not having the super high yield that shows, 40% return or 100% return. And the other thing is with these yield max funds, some of the return is actually your own equity to be able to make those returns look better than they are. Just learn a little bit about it. Anyway, I don't mean to be all preachy, and have a great day. If you haven't already, hit that subscribe button, smash the like button. Let me know what you think. Have any of you owned these funds and have you had success with them? And if you have, what do you like about them? Because as I've said, I really hate them. Anyway, have a great day and I'll talk to you guys soon.